The world economy is undergoing a profound transformation, moving from the age-old barter system to an increasingly digital currency landscape. This evolution reflects centuries of innovation in how value is exchanged, culminating in the nascent era of digital and distributed ledger technologies. From barter to fiat, a historical overview. 1. Barter system, ancient times. In the earliest forms of trade, goods and services were directly exchanged without a common medium. This system, while functional for localized and simple economies, suffered from significant limitations. Double coincidence of wants. Both parties needed to desire what the other possessed. Indivisibility. It was difficult to exchange large, indivisible goods for smaller ones. Lack of a common measure of value. Valuing disparate goods against each other was subjective and inefficient. 2. Commodity money, early civilizations. To overcome the inefficiencies of barter, societies began using universally desired and durable commodities as money. Examples include salt, animal skins, shells, grains, and precious metals like gold and silver. These served as a medium of exchange, a store of value, and a unit of account, albeit with varying degrees of success. 3. Metallic money, coins. Lydia, China, till the 7th-6th century BCE. The standardization of metallic money through coinage marked a significant leap. Coins offered portability, durability, divisibility, and intrinsic value, making transactions more efficient and expanding trade. The first known coins were minted in Lydia and China. 4. Paper money. China, 7th century CE, Europe, 17th century CE. The invention of paper money was a response to the cumbersome nature of carrying large quantities of metal coins. Initially, paper notes were claims on metallic reserves held in banks, representative money. Over time, paper money evolved into fiat currency, deriving its value from government decree and public trust, rather than being backed by a physical commodity. This allowed for greater flexibility in monetary policy and facilitated large-scale international trade. 5. Checks, credit, and electronic funds, 20th century. The 20th century saw the widespread adoption of checks, credit cards, and electronic fund transfers. These innovations further dematerialized money, moving transactions from physical cash to electronic entries in bank ledgers, dramatically increasing the speed and volume of transactions. The dawn of the digital currency system. The 21st century is witnessing the rise of purely digital forms of currency, driven by advancements in computing and cryptography. 1. Electronic money and mobile payments. The ubiquity of the internet and smartphones has led to the widespread use of electronic money, e-money, and mobile payment systems, e.g., PayPal, Venmo, mobile banking apps. These facilitate instant transfers and payments without physical cash. 2. Cryptocurrencies, e.g., Bitcoin, Ethereum, 2009 onwards. Cryptocurrencies represent a decentralized blockchain-based form of digital money. Their key characteristics include decentralization. No central authority, like a central bank, controls them. Security. Transactions are secured by cryptographic techniques. Transparency, pseudonymous. All transactions are recorded on a public ledger, blockchain, but identities are typically pseudonymous. Volatility. Many cryptocurrencies experience significant price fluctuations, limiting their widespread use as a stable medium of exchange. Financial inclusion. They offer 3. Central bank digital currencies, CBDCs. A growing number of central banks worldwide are exploring or developing their own digital currencies. CBDCs are distinct from cryptocurrencies in that they are centralized, issued and backed by a country's central bank, fiat-backed. They are a digital form of a country's fiat currency. Programmable, potentially offering features like expiry dates or specific usage restrictions. Potential impacts of digital currencies on the global economy. Increased efficiency and lower costs. Digital currencies can significantly reduce transaction costs and settlement times for domestic and cross-border payments, benefiting international trade and remittances. Financial inclusion. They can provide access to financial services for individuals and businesses currently outside the traditional banking system. Enhanced monetary policy for CBDCs. Central banks could gain new tools for implementing monetary policy, potentially influencing interest rates or directly distributing funds. Reduced illicit activities for CBDCs. The traceability of CBDC transactions could aid in combating money laundering and terrorist financing. Competition and innovation. The emergence of digital currencies fosters innovation in financial services and encourages competition among payment providers. Challenges to traditional banking. CBDCs could potentially disintermediate commercial banks, impacting their business models. Challenges and considerations for global digital currency adoption. Regulatory frameworks. Developing consistent and effective global regulations for digital currencies is crucial to prevent financial crime and ensure stability. Cybersecurity and privacy. Robust security measures are essential to protect against cyber attacks and fraud, while also addressing privacy concerns associated with traceable transactions. Interoperability. Ensuring that different digital currencies and payment systems can seamlessly interact is vital for a truly global digital economy. Financial stability. Uncontrolled proliferation or instability of certain digital currencies could pose risks to financial stability. Monetary sovereignty. The rise of private global digital currencies could challenge the monetary sovereignty of individual nations. Digital divide. Ensuring equitable access and digital literacy across all populations is crucial to prevent exacerbating existing inequalities. The transition from a barter system to a global digital currency system is a monumental shift, promising greater efficiency, inclusion, and potentially new models of economic interaction. However, navigating this transformation successfully requires careful consideration of technological, regulatory, and socio-economic challenges to ensure a stable, secure, and equitable global financial future.